Stocks fell across the board today with the Dow tumbling 94 points. Nervous investors are focusing not only on growing global debt fears, but on a new bearish economic report from none other than Goldman Sachs. Suggests that the worst may lie ahead for the sputtering U.S. economy. How much damage is all this going to inflict on the stock market? It looks like it's already started. So let's talk. Here now is Anthony Scaramucci. President, he's managing partner at Skybridge Capital. Lee Munson, chief investment officer at Portfolio, and Jimmy Pethokoukis, money and politics columnist at Reuters, CNBC contributor. Jimmy P., you broke this story, or at least I saw it. Maybe the Goldman clients got it first. How dismal is the Goldman forecast? I think it affected stocks.
It's pretty dismal. They see the unemployment rate falling not very much at all from 9.2%. Currently at about 8.75% by Election Day 2012. They also think that given the current data, the bad consumer numbers, the bad numbers all over, including employment, they think another recession is really possible.
Employment, retail sales, industrial production. And you know what? I saw several economists today, Jimmy. They talked about those awful consumer sentiment numbers from Michigan last Friday, which are really at a recessionary level.
The recessionary level. And remember that when economies begin to grow slowly, sub 2%, the odds of that sputtering turning to a stall goes up dramatically. It's like nothing else can go wrong. If you look at Europe, you can see other things that might go wrong.
No shocks. How about here in the U.S.? Anthony, let me ask you, what do you make of all this? Goldman downgrade, other econs are doing the same thing. Does it affect your strategy?
It doesn't affect my strategy personally, Larry, but, Bernanke's on the other side of that, right? You heard the testimony last week. He actually thinks the economy is going to grow into the second half. I don't think it's the Goldman report. Goldman may be right. I don't know. Economists should all be one-handed. We both know that, right? So you can't say on the other hand.
Scary thought.
So I don't know the answer to that. But here's what I know is that we're on the 32nd anniversary of the malaise speech from Jimmy Carter.
Jimmy Carter.
And what I know.
You think this is like the Carter?
What I know is there's a crisis of political leadership and a crisis of confidence, particularly as it relates to the executive branch of the United States, with American business people.
Are you selling into that crisis?
I'm not selling into that crisis because the assets right now are very cheap. If you look across the board of the S&P 500, you're almost up to $2 trillion in cash now on the balance sheet of the S&P 500. It's the largest cash treasure trove since 1956.
Yes. But, Lee, what if they don't put that cash to work? That's another question. They've got the money. Anthony's exactly right. It's at home. It's overseas. I'd like to help them bring it back if it's overseas. But what if they don't put that money to work?
Well, I think it's going to start crimping the earnings power. If we don't get the money to work, we're never going to get the PE expansion that a lot of the market bulls say is going to move the market higher. Right now, with only, we've talked about this, 1%, 2% growth. If we don't put the money in work, we're not going to have the leverage or the liquidity turning the velocity of money over.
Are you selling into this? You're buying into this. That's what you're saying. Assets have value. What are you doing?
Directional basis, yes.
If I need to commit capital right now, I am buying some of the defensive names, like, your Pfizers and your General Mills. If we see a little bit more softness, then I'll be ready to buy the entire market. I do think the market's generally cheap. If you're buying today, I would just buy those first things that are a little bit cheaper. We bought some CIT, some Travelers, those down-and-out financials. But overall, I think you can get money here. I think you should be bullish.
Anthony, just quickly, is the debt ceiling issue overrated for the stock market, or is it rated?
I think it's rated because, again, it creates this political uncertainty. There is a crisis in Washington. People feel it on the street. You're losing retail investors on the sidelines. Institutional investors, they have no reason to
losing
buy
retail
right now.
Because of the debt crisis,
because
or just
of
the lack of confidence?
Lack of confidence, uncertainty in the government. Remember, Larry, no one knows what their costs are. Do you know what your Medicaid is going to be next year?
In the next couple of years.
Nobody knows.
Medicare,
nobody knows their taxes. So people are frozen and they're on the sidelines. It's not a good investment environment.
What's your favorite play right now?
Well, I like the directional equity move. I like things.
Directional up.
Directional.
Because right now it looks like this big rally is faltering.
Directional equities, risk arbitrage, things that are moving, that are going to move right now, or look for more merger Mondays. You'll see large cap companies buying small cap companies and playing that consolidation and the PE multiple differential.
Would you buy the small caps on the bet that they're going to be acquired by the big caps? I mean, this is a little bit of a shell game. Nobody's creating new jobs. Nobody's creating new startups. There's no Schumpeterian gales of creative destruction. The big fish are going to buy the small fish. Now, that may add to efficiency. Do you buy the small fish in anticipation of the big fish coming in?
Not at this price. I would probably avoid that. I really like the larger players that basically the hedge fund money is going to flow into right now the things that are cheap and people see as relatively safe if we get more downside because of the debt ceiling sentiment. That's what Goldman Sachs was all about right now. It's not about how awful the economy, it's not great, but it's really about we had this June run-up because we thought
it could be about how awful the economy is. Well, Jimmy Pethokoukis, you know, your point, when you get to 1.5% growth, look, Goldman, just to put this on the scoreboard, they're saying 1.5% in the second quarter and 2.5% in the third quarter, but they used to say 3.25%. They're just marking it down. Economists move
slowly,
like lemmings. You know that. One shock, like how about this, Jimmy P? I'm going to give you the last word.
Right.
A debt downgrade by Moody's and S&P of the U.S. government because they might raise the debt ceiling, but they can't get to $4 trillion. There's no structural reform. What about that shock, Jimmy P?
I think that would be a negative shock, and you're right. I don't see, really, given what they're talking about, how the debt does not get downgraded. It's going to take some fancy talk and some fancy calculus.
You're not worried about debt downgrade,
done.
Lee Munson? Real fast.
No, I'm not.
No, you're not. Anthony?
I wish I was.
All right. I can't make the sale, Jimmy. Just kind of putting it out there. You're all great.
We'll try again.
Pethokoukis, Anthony Scaramucci, and Lee Munson. You're basically two bulls here.
Yeah, we're two bulls. We were so close.
Two bulls and a very good reporter.